Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen, hopefully in the week ahead. I've just got to show you the disclaimer, which is here, and I'll just run through what we'll get through in the next 30, 40 minutes or so. It's pretty busy again. Markets are at the moment, which is very exciting, I think. Just quite unreal how many different drivers there are, how many different catalysts, sort of short term, long term, and then obviously lots of opportunities as well. Trading opportunities is especially. There's the disclaimer. If I just get through them, what we hope to get through, yeah, next 30, 40 minutes or so, as I say, standard format, really. And if you do have any questions, please do ask them along the way. More than happy to answer what we're looking at, any questions on that, or what you're looking at, any trade setups, or any of the fundamentals as well. So, yeah, normal format, really. We'll just check out how, we'll check out how markets are trading, but we'll just look at two big themes at the moment, which are kicked off this week. That is the Japanese yen and yen strength, and then precious metals and strength in, of course, silver and gold, especially. So we'll just check those out and a few thoughts around that. We'll then look at stock markets and earnings. About 100 of the S&P 500 reporting this week, including 4 of the Mag 7. So, yeah, we'll just get into a little bit of that. And the underperformance, really, of the Mag 7. We've borrowed the name actually, but I know some people are now calling them the Lag Seven. Excuse the pun or not. But yes, we'll look at that Lag Seven and whether they can become the Mag Seven again. I guess is the point. With 4, as I say, of those mega cap tech companies reporting this week. So we'll briefly look at that. Then we'll get into data wise. Look at last week's main data points. So Bank of Japan meeting on Friday. We had a bunch of UK data as well. So we'll look at cable, look at dollar yen, of course. And then we'll get into this week's main risk events. The Fed, of course, nothing much expected, actually, to be perfectly honest, but always important to watch that. And probably the press conference and Q&A will be the most important there. Potentially we get the Fed chair nominee as well. Interesting change there, actually. So we'll focus on that after the Fed meeting. We've got the Bank of Canada meeting as well, expected to be unchanged. But we'll look at that with dollar CAD. And hopefully, if we've got time, there is some important quarterly inflation data out of Australia. So we'll look at Aussie dollar and the expectations on that, on those numbers. Okay, first up, really is just bear with me 1 second. Yeah, how markets are trading currently. And dollar is getting hit, of course, with this yen strength. Is effectively pushing up the euro dollar, pushing up sterling against the dollar. All currencies much stronger against the greenback. And we'll get into that shortly. Futures slightly in the red after a pretty quiet day on Friday on the S&P 500 at least. Nasdaq futures showing actually a third of percent down. European stocks slightly struggling at the moment, but yeah, attention on dollar yen and also, as I say, on gold and silver. Gold currently up over 2% now, close to 5,100. It did touch that level, I think, after blasting through 5,000, of course. Silver as well beat the $100 mark on Friday, up to 110, I think now. Incredible runs, and we'll look at that very soon. Okay, first up, stocks then. Actually, sorry, before we get to stocks, sorry, the two main points. If I pull up dollar yen, first of all, sorry, I thought I had a chart about dollar yen. Just bear with me 1 second. I'll firstly pull up, these two themes, obviously, being yen strength and also precious metal strength, as I said. So here is the dollar yen chart. This is yeah, pretty important move for the yen, going through the roof really against all its global peers, especially the dollar. You can see on Friday we kind of fell off a cliff. Really, it was really interesting getting to this point. You can just see how technicals can be very important. Really, January high from last year, 158.87, bobbing about there, trading around there just below as well. Looked a bit like bullish consolidation really before a big move higher. Bullish consolidation is a pause in the trend, and generally prices would move in line with the long-term trend, which is up. But obviously, huge levels for the Ministry of Finance and intervention levels, which we've talked about numerous occasions in our daily commentary. So that was probably the first line in the sand. We thought it could have been higher, actually around 160, 162 potentially. But anyway, 158.87. Tried breaking through a couple of times, and you can just see on Friday then collapse really, as I say, fell off a cliff essentially from a high actually at 159.23 that was down to 155.70 close. And we're then seeing another sharp move down today. We're down 1.2%, just over, down to where 153.55 earlier, now 153.82. So we've broken support 154.83, which is a fib level of the January to April move. You can see there. And we're now trading below that and also below some of the December lows. We're just hanging around that level, actually. So interesting there on the technical side. Obviously, we've got the big figure at 154, and I think the 100-day moving average is around that level as well. I've got the 200-day. Just bear with me 1 second, and I'll just show you the 100-day. I'm sure you know how to do this, but that's how we move the 100-day, and you can just see, yeah, bang on. 153.54 is the 100-day. So a little bit of support there, and then yeah, nothing much then to the next major fib level at 151.61, that dotted line. So big moves in yen, in dollar yen. And yen strength, really, if we just think about it then, apart from the technicals, that originated after the Bank of Japan Governor Ueda. He concluded his press conference and he kind of disappointed a few yen bulls, really, with obviously this very, very slow hiking cycle that we're seeing, even as inflation remains well north of the 2% target. I'll get into the Bank of Japan a bit later, but that prompted the intraday high in dollar yen. And then really we got rumors through Friday of institutions basically being asked to check on the yen's exchange rate. If you do trade dollar yen, or even look at it, if you follow some of these moves on Twitter, I guess, and on other news media outlets, really, everybody gets very, very excited about when, and if these financial institutions are being asked by basically the Ministry of Finance and by, well, as we know now, the New York Fed. I'll get to that shortly, but as I say, when they're asked to check the exchange rate, and I've worked on a trading desk in a big bank, not on the FX desk, but been around those guys and those people who yeah, get very excited. There's a lot of sort of excitement and hubbub really around the trading floor when that's happening. Everybody knows it's happening. Just being checked, I mean, not actual intervention, but just being checked is quite exciting in itself. And that's typically the last stage before actual then FX intervention, physical intervention. So that's why it's very important. This time around, though, as I say, it wasn't just the Japanese authorities doing the rate check, it was actually the New York Fed. That kind of suggests possible coordinated FX a market response, in which one party, at least the US, essentially has pretty much unlimited firepower to buy the yen and sell the dollar. Of course, Japanese authorities have been frustrated over yen weakness for quite some time. And as we know, over the last few years, certainly since 2022, have stepped up themselves singularly, so unilaterally, a couple of times. And the last time being in summer 2024, when the MOF sold, I think, over or around $100 billion worth of yen. So really interesting, this possible coordinated buying operation. The last one, just for your guide, was in 1998. And generally, FX experts really think unilateral intervention is tough to achieve on a long term basis. But if it is coordinated, much bigger chance of that intervention working. So yeah, there's some background on this move, getting a lot of headlines, and just final thoughts really. Why would Washington? Why would the White House want to get involved? Probably two reasons there. Firstly, the weak yen was adding really to this big sell-off we saw in Japanese government bonds, and that was then driving up U.S. Treasuries as well indirectly. Um, and really, one of the key planks of the Trump White House at the moment is certainly US Treasuries and yields staying low. That is, yeah, one of the financial instruments most important to, well, Treasury Secretary Bessent and President Trump, other than the stock market, certainly. So they don't want yields higher. JGB sell-off, Japanese government bond sell-off, was driving those yields to record highs or historic highs in the long end in the 30-year JGB yield. And that was pushing up US Treasuries, which is certainly what they do not want in the White House. Second reason, strong dollar yen potentially unwinding the work of US tariffs on Japan, and then gives Japanese manufacturers a competitive advantage. So, yeah, just a couple of thoughts around that. Really interesting. And we're obviously now seeing broader dollar weakness as well. As I said, euro dollar got close to 119, I think. Cable hit 5 months highs earlier, although we're just pulling back slightly. And interesting, really, the broader picture, if you like, as well, especially for the euro, is we're seeing continued strong flows into, well, EM equity ETFs. That supports the global growth story and moves funds away from the dollar. Surging gold and the Swiss franc also really maintaining that sort of dollar debasement theme, which you must have heard about, and people moving away from the dollar, essentially dollar de-dollarization is what I've called it as well. And that theme continuing with this move, really interesting. And we'll get to some of the crosses on yen as well later. Secondly, then the other theme, just quickly, if I can, precious metals, of course. As I said, silver broke $100 for the first time on Friday. That strength continues today. $110, I think we touched. Gold, of course, broke 5,000 earlier this morning. All on sort of escalating geopolitical tensions, really boosting demand for safe havens. That's the easy answer, I think. Both metals, though, certainly huge gains last year. Triple digits for silver, of course, gold as well, up over 60% last year. This year, even gold now up around 18%. Silver climbed 50% this year, just this year. Incredible moves. Driven by really, well, series of geopolitical shocks, of course. Washington's stance on Greenland, of course, exacerbated that. Lingering concerns around potential US-Iran escalation. But then we've got those familiar themes we've written about over many months, really. Lower yields, expectations for Fed rate cuts, policy uncertainty, of course. And then obviously this weaker dollar as well today, really reinforcing investor appetite for hard assets. I think that's the key two words there: hard assets. And scarcity really is a big theme in stocks really at the moment as well. So hard assets, physical assets is what investors are looking for. And that has driven gold and silver prices for sure. Interesting for silver, though, just to get on that, as well as safe haven flows, certainly is, you have to remember it's a robust, or has seen and will see robust industrial demand. And also, you have to remember it's a much smaller market size for silver. So it has this sort of dual role as both an industrial and an investment metal, and that kind of continues to amplify price volatility. You also have got, of course, tightening physical balances in silver amid constrained mine supply growth, and that just simply adds further upward pressure to this already parabolic move, it has to be said. But obviously, going forward, I guess this is what we need to think about. Market conditions, if they remain volatile, the de-dollarization theme remains, then that sort of broader backdrop does remain supportive. Geopolitical tensions and central bank buying, we've also got structural supply deficits, leave really both metals quite well positioned still. And certainly silver's tight physical market and then that strong industrial demand, as I've said a few times now, that should provide a solid floor, even if we get some sort of concentrated profit taking. Um, Elevated volatility for sure, but and potentially sharp price swings because certainly if you pull up gold, we're overbought on 84 on the daily RSI now, 81 or so the weekly, and this one's a kicker. Monthly RSI at 95. It can carry on, no doubt about it. History tells us that, but at some point we will get some sort of correction. You can see sometimes doesn't have to be massive, although we did dip there, for example, in 2022. But then obviously incredible run since that point. Silver as well. Just let me pull that chart up. I mean, look at that. Incredible ride from July of last year, really, when we were trading around 34. I remember looking at it at 28, but didn't do too much. But there we go. I looked at it at 48 at least. But there we go. We're now, yeah, close to 110. That monthly RSI at 95, the weekly, yeah, 89 or so, 88, and then yeah, similar. So yeah, thoughts on silver and gold, strong sort of backdrop really, with potential sharp swings in either direction at the moment. Okay, moving on from that to stocks then. Just bear with me one second. Just want to then highlight obviously the earnings we get, as I mentioned. Yeah, 100 or so firms of the S&P 500 reporting includes names, defense names to start off with: Lockheed Martin, Northrop Grumman, Boeing, RTX. We also get some of the credit cards companies, Visa and Mastercard. They report later in the week, I think, and then selected names, sort of GM, IBM, Starbucks as well. So a whole host of companies to look out for. Of course, four of the seven Mag 7 will report, as I said. So Microsoft, Meta, and Tesla, they report after the US closing bell on Wednesday. And then on Thursday, we get Apple and Caterpillar, just for your guy, but Apple on Thursday after the market close. The Mags 4, then, that's more than $10 billion market cap, and that's over 16% of the S&P 500 market cap. So, yes, very important and interesting, really, especially at this time where we are getting the Mag 7 lagging then the broader index, as well as, of course, then this move away from the US and overseas markets, specifically really outperforming even the S&P 500 as well. That's been going on for a few months now. Yeah, an interesting point then for these earnings coming out over the next few days. Of course, we've had geopolitical ructions, but it is, as I say, pockets of the market beyond AI that are performing much stronger. And it's really interesting. The Mag 7, of course, they might find, sorry, shareholders have become accustomed to blockbuster results, but we kind of want even more now. And we've seen that in some of the results. For example, last week with Intel got smashed down 17%. Numbers not bad, guidance not convincing. And that will be the key, really, for these four companies. Of course, as well, we'll be looking at their massive spending, funded increasingly by debt in some cases. and that spending around, of course, the global AI arms race. Whether that is paying off or not will be key. Because really, as I said, it's no longer good enough to beat forecasts now. Companies really have to smash those out of the park, really, and then offer that really exciting guidance to keep investors feeling comfortable about the very lofty valuations in these companies. This chart really, yeah, just shows you that underperformance, as I say. Um, and just then looking at the company specifically, very briefly. So, Microsoft expected to post double-digit earnings and revenue growth, with AI cloud being a key engine that potentially keeps that stock held aloft. Apple, again, also expected to post double-digit earnings and revenue growth. We'll be focusing on iPhone demand, of course, services, and then China as well. That is, again, all those three areas key for keeping that bull market sort of support intact, if you like. Meta, that's forecast to deliver hefty ad-driven revenue growth, but there will be close scrutiny on AI, always on Meta now, and Reality Labs spending. While Tesla, will be about the numbers, expected to show weaker EPS and revenue on price cuts and margin pressure, and that potentially makes it a bigger drag on, risk sentiment overall. If we look at these stock charts then, just quickly, just bear with me 1 second, grab the charts first up. First up, let's go to Microsoft. Where are we? Which is here. So options prices, they have priced in a sort of a plus or minus 4.6% move after the numbers. So that would be on Thursday's open, essentially. So yeah, just the chart, interesting. We're below the 50-day moving average. That's at 481. You can see the blue line, black line, 200-day moving average. That's above that at 497. And then we got the low from last week at 438.68. So yeah, that'll be first level of support. Then you've got obviously the gap from Liberation Day. It's not Liberation Day, actually. Sorry, it's the earnings gap there from May last year, which is at 424.90 as well. So interesting few levels for Microsoft. For Meta, options pricing in a plus or minus 5.8% move after results are released. Again, just beating the 50-day moving average here. So that's at 639. And that's interesting. That tallies with the halfway point of the Liberation Day rally, that halfway point being at 638.03, I think. So that's a level of support. Otherwise, you've got those recent lows just above 600, literally. So that's a good round number of support. And then you've got these key lows from November of last year, around sort of 583, 585. So some key support levels there. Upside, you've got the fib level at 675, and then the 200-day moving average at 681 to look out for. Yeah, on the upside. Tesla, options pricing in a plus or minus 4.6% move. Interesting. We're just above the 200-day and the 50-day. So that's at 432 and 442 respectively. Just below there, you've got the minor fib level of 412. Although the previous high was 474.07, you can see, but I need to take that higher actually. Apologies. So roughly there, shall we say, was it 498.83? Yeah, so roughly there. So you've got the first minor fib level, which we're just above now, which is along with a 200-day moving average around 432, 431, 50-day, we're above that. So that's interesting at 442, with the record high just below 500. Some nice round numbers there to remember. And then finally, Apple, if we quickly look at this chart, Lagging and below both the 50-day and the 200-day. They're at 269 and 260 respectively. Last week's lows at 243.42. So tough. If we lose that, then we're down to this fib level at 236 for us. As I say, options prices, sorry, plus or minus 3.7%. So we could potentially lose that last week's low, which is decent support, and then move lower. We shall see. Okay, those are earnings and the Mag 4 who are reporting this week, of course. Let's move on then to last week's main data points. So firstly, UK CPI and then the Bank of Japan meeting we'll look at. UK CPI data didn't really surprise. Modest pickup in inflation into year end. So it picked up from 3.2 to 3.4%. 0.1% move was expected. The core rate, that was unchanged at 3.2, and services came in at 4.5% from 4.4. Details really, the increase is probably down to flights actually around Christmas and the New Year period. But core services, a number the Bank of England look at, was unchanged at 4%. Data really follows actually jobs data as well last week. That certainly underlined the slight worsening really in the UK labour market. So the employment data that revealed a 43,000 drop in employment following a 33,000 drop in November. That decline actually was the largest since COVID and kind of raised expectations of really continued decline in wage growth. The wage growth data was less compelling, actually, though it still indicated a gradual softening. We got private sector wages. They slowed from 3.9 to 3.6, which is actually the weakest growth rate since November 2020. Bottom line then from those bits of data, and actually retail sales were decent on the Friday out of the UK. Not probably going to alter the views of the Bank of England too much. And that means not really a massive impact on shaping policy rate expectations going forward. There was a lack of market reaction as well, really. And potentially it means possibly they could still, markets be looking underpriced really for rate cuts ahead. There's only around 6 basis points of easing for March. So that's around a 25% chance, 1 in 4 chance of a rate move in March. And that's despite the pickup in inflation in today's data, which actually was anticipated by the Bank of England. Otherwise, if we do get disinflation, so for more falling inflation numbers going forward, then certainly the scope for the cuts, as I say, could increase. And that could mean sterling underperformance ahead. That would probably be mainly reflected against the euro. Let's look at then sterling cable. So sterling against the dollar, and we'll also look at euro dollar, euro sterling as well. Bear with me 1 second. Not really reflective of that data, as I say. Pretty muted reaction after the data. Really, we're being driven, of course, by the weak dollar. But we got a nice sort of support level around the 200-day and 50-day moving average is actually there at 133.65 and 133.62 now. But you can just see that last week's down move from Monday last week actually dipped to 133.87. Now we pushed up out of this sort of bearish sort of consolidation channel, really. We're up to 136.19, just above there, that minor fib level. And then we've got probably this high from September at 137.26. And then the high back in July of last year, that's at 137.84 or so. So that's cable, just slightly getting in towards overbought territory, but really a nice move higher there. But as I say, not on the back of the data, really on the back of course, the weaker dollar. We also got the Bank of Japan meeting. I've looked at dollar yen already, but we'll look at some of the crosses. Actually, I said I'd look at euro sterling. Sorry, thinking of too many things here. Euro sterling here. Interesting point, actually. Really strong support then around sort of 86.50 or so. You can see that there. Upside capped by the 200-day and 50-day moving averages, the blue and black lines. That's 83.73. No, sorry, 87.31. Sorry, and 87.25. That's the 200-day and 50-day moving averages. And then strong support, I would say, around here. You can see that around 86.50 or so. So an interesting few levels there, whether we break down further or whether we can push up through those long-term moving averages. As I said, a look at some crosses in yen as well, having looked at the Bank of Japan meeting. Let's just put up a chart before we talk about the Bank of Japan meeting. Um, Sterling yen got to a very, very big long-term level. You can see going back to '08 there, 214.11. If we go to the daily, we tapped it a couple of times. Now we moved off it. So really interesting, huge level of resistance that. And the 50-day potentially finding some support around 209. Bank of Japan, just for your guide, they left rates unchanged at 0.75%, but the message was moderately hawkish in the end. Decision passed was 8-1, with one member calling for an immediate hike to 1%, arguing inflation is already at target and risks are skewed higher. The bank, they upgraded near-term growth forecasts helped by government stimulus and left headline inflation mostly unchanged. The key shift was in underlying inflation, really. Core CPI is what they call it. That is now forecast higher across the entire outlook, driven by a tightening labour market and rising wage pressure. And the bank openly acknowledged that labour shortages mean wages and prices could rise faster than expected. Crucially, the bank said if this outlook plays out, it will continue raising rates and dial back monetary support. As I said, initial sort of spike higher in dollar yen in these currencies, and then sharp move lower as well, driven by that intervention fears, the joint intervention, if you like. Markets pricing for the Bank of Japan, that's interesting. A hike to 1% now already fully priced by June, and rates, year-end rates, seen at 1.25 to 1.5%. As I say, initial reaction was muted, but obviously we got this move lower in the crosses. Further fiscal stimulus looks inevitable as election campaigns have been kicked off with VAT cut promises from all major players. Of course, we get that election on February 8th. That move, of course, propelled, as I've mentioned, government bonds higher at a fast pace. And then that weaker yen was threatening to really exacerbate inflation problems. Overall, then, we have seen yen strength, as I say. Bank of Japan generally relatively bullish as well, hawkish really. So that is helping this move. But of course, if it changes, higher rates, a stronger yen are headwinds, particularly for exporters, just to note. Probably get more volatility and rotation rather than a straight line rally, although that's what we're seeing at the moment. But for the Bank of Japan, they're really laying the groundwork for steady tightening. As I say, pretty slow pace, but it is steady tightening. And markets really treating that, rate markets at least, that way. Okay, let's move on then to this week's main events. I don't see any questions, so hopefully all clear for you guys. Let's now briefly get into, this week's main events. So central bank meetings and some Australian CPI data that comes after very strong employment data, which hopefully you get to. But the Fed first up. Here's a graphic really of the main numbers. Hopefully you like this. Widely expected to keep policy rate unchanged at 3.5 to 3.75%. As really has been the case for several meetings now, decision itself matters less really than the guidance that they give. That may be in the statement or, of course, at the press conference and Q&A with Fed Chair Powell afterwards. Really, it's highlighted sort of how patient policymakers intend to be before possibly easing comes into view again. Recent data that's continued really to underline the resilient US economy with sticky inflation and jobs market, which is slowing, but also not collapsing really. And of course, we still have stock markets near record highs. That all really argues for or against, sorry, any urgency to cut rates. The economy expanded strongly in the second half of 2025 last year. Inflation, as I said, remains above target. And the Fed's preference really is for patience, as I've said. Policymakers likely then to repeat their data dependent messaging and avoid signaling easing is imminent. Markets certainly will pay closer attention, as I said, to any tonal shift by Fed Chair Powell, particularly given, of course, growing political pressure on the central bank. That is, of course, on Powell over the refurbishment costs, but really, as he said, that's more likely down to pressure to cut rates. That is, of course, unprecedented, that criticism. And will be interesting whether Powell says anything, but generally he does very much steer clear of any political commentary. Overall, then, the balance of risk point to rates remaining on hold, probably through the first quarter. Cuts more likely later in the year if inflation shows clearer signs of moderation, because officials really slightly worried still about the tariff pass through. If that is not occurring or companies are taking that up in their margins, then potentially, yeah, we do get more rate cuts going forward, which will, of course, support the economy and support stocks potentially as well. We will get expansionary fiscal policy that's expected later in the year as well. So all sort of reasons for why stocks are doing all very well supported. Yeah, market expectations, as I've put here, there's just around 25 basis point cuts priced in for the whole of this year now. First one not priced in until July, and a 1 in 3 chance at the moment only of a price cut by April. Let's just show you this chart as well, which shows you inflation still a bit sticky above that 2% target. And you can see the policy rate, the Fed's funds rate. If I just pull up the DXY chart, then dollar index chart, of course, I always tell everyone, you guys, every week, 6 of its main trading partners in this index, but the euro by far the biggest weighting, 56% or so. So yeah, big move down that you can see. And we're getting towards now really key levels. So we're getting towards that September low. That's at 96.21. Where are we currently? 97.18. So a little bit to go, but really interesting here. Plus then that low from July of last year, that's at 96.37. Currently trading at 97.19. So a little bit to go. And then you've got that long-term trend line that we like and we've used before, touching those lows from 2021 and 2011. And again, that acted as support previously last year. So interesting whether we play around these levels, but then find some very strong support or not. We shall see with some of these longest term themes playing out, of course, around de-dollarization and dollar debasement. One other thing I want to say very quickly, apart from before we get to the Bank of Canada meeting, as I mentioned, the Fed chair nominee potentially happening this week. Really interesting change here for the person who's going to take over in May. Because prediction markets, they are now betting on not a Kevin. It was a two-way race between the two Kevins, Walsh and Hassett, but now betting markets have moved in favor of somebody who does not work at the Fed. So the BlackRock's Rick Ryder, probably his greatest advantage, maybe his biggest drawback as well, is that, as I say, he hasn't worked at the Fed previously. But really interesting betting markets going now, putting money on him to be the next Fed chair. Potentially we get that announcement soon. Expectations, though, that the new chairman, this is the key point I think that I want to make, will execute a decisive break in a dovish direction are actually minimal. And if I just show you this chart, oh, sorry, I didn't show you the dollar index. I do have a question, so bear with me. It's probably, can you show us the dollar index chart? Bear with me 1 second. Yes, apologies. My fault. And here it is. So let's just quickly go over this. You can just see dip down below that dotted line. We've got the September lows at 96.21, as I said, and then that July low from last year at 96.37. And then if I go to the monthly chart, you can see this dotted line here. So it's supported prices in 2021 and 2011. So a very long-term trend line, and you can just see it worked last year as well. So just below that now, just around that level, depends where you put it, certainly. So interesting, really interesting points on the dollar index chart. Apologies about that. Hopefully you can see that now. And if we just move away from that, I just want to show you this chart, which is to do with the Fed chair nominee, as I say. Here it is. And this is just showing us really it's showing us, well, the Fed funds futures June contract. So implicit odds of the Fed funds futures June rate on a rate cut, even after the FOMC meeting. And the first under the new chair are now around 75%. So the projected rate now, sorry, this is my point, is the highest in 6 months for that June 2026 contract. So really not exactly what President Trump has been talking about in lower rates, because rates for that futures contract are the highest there have been, as you can see, in 6 months. So yeah, that's my point. Hopefully you've got that. But really interesting with, of course, Rick Ryder now being the favorite, at least on betting markets. We shall see. Okay, moving on from that to the Bank of Canada meeting. If I just pull up dollar CAD, which has tumbled in the last few days at least. Obviously, dollar weakness. But yeah, the Bank of Canada expected to keep rates unchanged at 2.25%. Data wise, headline inflation that rose actually to 2.4% in December from 2.2, slightly above expectations, down to unfavorable base effects, to be fair. But measures of core inflation, they were broadly stable. That's the preferred measure for the bank. Actually, the preferred measure eased even, and suggests really underlying price pressures remain very contained. Bottom line, they won't be swayed, policymakers, by that month-on-month volatility, certainly in headline, because they prefer the core measures anyway. They'll be focused on the underlying trend, which really sees it around the sort of mid 2% range. That's fine. That means they sit on their hands. Although, of course, there are these ongoing upside risks from US tariffs and, of course, elevated trade policy uncertainty. And I should have mentioned at the top of the webinar, of course, we had that news over the weekend with President Trump threatening Canada with 100% tariffs if they go through with the deal they're trying to do with China. Rate expectations for Bank of Canada pretty much on hold until potentially, well, at least through the first half and through to even next year. There is a semblance of a hike, I think, towards the end of this year priced in. Dollar CAD, then, you can just see this key level here, 136.42. That's from December. The December low, so that will be key. Otherwise, then we've got some swing lows here below that at around 135.75, and then certainly this low from June last year at 135.38. Upside, top side really, minor fib level, and then you've got the 50-day moving average at 138.61. Finally, let's quickly get to Aussie dollar. Yeah, why not? Everyone's still listening, which is brilliant. After 44 minutes, really appreciate it as always. We do get, as I say, inflation data. We got very strong employment data last week. I should touch upon unemployment rate that dropped to 4.1%. Employment jumped by 65,000, and that was heavily driven by full-time hiring as well. That saw a big jump in 2 year swap rates. So interest rates basically for Australia. And yeah, the inflation data we get, just checking when that is, on Wednesday. Um, Focus will be on the quarterly print. Headline in November, it stood at 3.4%, so above, remember, the target band for the RBA of 2 to 3%. Though the central bank in December actually said a recent firmness in underlying inflation reflected temporary factors. So attention turns to Q4 after the Q3 number edged up to 3.2%. Expectations really are for a firm outcome. No particular 3.3%, I think, is the outcome year on year, 0.9% Q on Q. That is above the RBA's own projections of 0.75% Q on Q and 3.2% year on year. Basically, ongoing pressure from housing costs, services inflation, and also new cars. Um, Certainly any upside surprise, and that's what most people, most economists are thinking, I think, in these numbers for Q4 inflation. That reinforces the tightening bias. At the moment, there's around a 60% chance of a February rate hike. That's up from roughly 30% before last week's employment data that we just talked about. So that 60% can certainly go higher and really lock in that Feb rate hike. Aussie has benefited, of course, with this um, strong data, of course, hike potential. And then also just the certainly with Greenland kicking off, then the dollar going lower, and also just the nature, the location of Aussie and also the Kiwi, which did well last week. If I just show you that big jump higher in the Kiwi. But the Aussie, we've highlighted this actually, this figure, which looked a long way off, but is now much closer, which is this high from September 2024 at 69.42. We're not far away. Really interesting because we have been highlighting and everyone who obviously tunes in, we've been talking about this range really, hadn't we? 64, 66 or so. And we said, as we always say, the longer we trade in a range, then the bigger the breakout will be. Obviously, we moved up to the top of that range and just above it, and then consolidated there. Really bullish sign, really, before then this big sharp push higher. So 169, sorry, 69.42 key level there. In fact, if we go higher, then where are we again? We've probably got this high here from 2023 now, but that's much higher, just above 70. So, yeah, interesting move with Aussie. But that has been expected for some time by a lot of Wall Street investment banks. I know they've been bullish on the Aussie for some time, but now that is paying off. So interesting price action there. Okay, I will wrap it up there. 48 minutes, quite a long time, but hopefully proved of use to everyone. Really, again, can't say how much I appreciate you being on the call for this long and always tuning in. There is a group of you, I think, who are really great to see you always every week listening in. So, yeah, hope that's proved of use. As I say, please do follow us on social media. And as I always say, that daily commentary goes out on the website after the US close every day as well. Take care. A lot happening with earnings, certainly. Central banks probably in the background slightly, but earnings and, of course, all the geopolitics ongoing. So take care, and we will speak to you same time next week.